Okay, so this is for the subject capital markets, and the specific topic for this one is still financial intermediaries, but we'll be focusing on the meaning, functions, and importance. We have here an article from efinancemanagement.com. Okay, so again, for the definition, entity that facilitates a financial transaction between two parties. Okay, you have the people with excess funds, and then you're connecting them with people who are in need of funds. Intermediary, middleman. Such an intermediary or middleman could be a firm or an institution, normally financial institutions, bank and non-bank financial institutions. Some examples of financial intermediaries are banks, insurance companies, pension funds, investment banks, and more. Okay? One can also say that the primary objective of the financial intermediaries is to channel savings into investments. Okay? Normally, in the form of bank as a financial intermediary, majority of its funds come from deposits. Okay, not exactly investments, because deposits, the earnings is very little, just less than 1% annually, and so they're channeling it from savings to investments, because they're giving the money as loans or borrowings to businesses or entrepreneurs who will then use it to expand their operations or to improve their operations. Okay? These intermediaries charge a fee for their services. So you have your processing fee, and then other than that, of course, they're charging interest payments. Okay? Financial intermediaries have emerged as a useful tool for the efficient market system, as they help channelize savings into investment. However, they can also be a cause of concern, as the subprime crisis shows. Okay, but again, back then, financial institutions were not, regulated, and so in current situation, in current times, they are being regulated. So in a way, they should be relatively safe. But okay, often there is a need to regulate the activities of these intermediaries, and that's currently the situation. Okay, financial intermediaries, entities that facilitates financial transactions between two parties. Intermediary could be a firm or institution. Examples: bank, mutual funds, financial advisors, credit unions. Their functions: convert savings into investments, and then provides cash facilities, liquidity of securities or investments, providing loans to those in need, especially businesses, and then assist clients to grow their investments. All right. Advantages: lowers the default risk, because they do have assessment or process that has been in a way tested, and would assure that people who they would be lending the money to would be able to repay the loans. Okay, and of course there's section of applications for loans. They do not always approve those applications. All right. And then they save time and cost, because they are doing this on a large scale and they are catering to a lot of people, right? Helps customize services for clients. Over the years, there are various financial services that have, popped up because of, changing demands, changing needs in the market. And the financial institutions are trying to provide for those needs as well. Lowers the problem of asymmetric information. Okay. They are currently, what do you call it? Not just them, right? Almost every business is now acknowledging the importance of information and using information in the decision-making process, right? Examples of financial intermediaries. Intermediaries are licensed to accept deposits for the banks, and then give loans and offer many other financial services to the public. They play a major role in the economic stability of a country. They are providing funds to the businesses, and then they generate employment, and then they produce the goods and services that are being bought in the market that would translate to economic growth and economic development. Okay. They play a major role in the stability of a country that face heavy regulations. Another example, so you have your bank and your mutual funds help pool savings of individual investors into financial markets. A fund manager oversees a mutual fund and allocates the funds to different investment products. Okay? So, diversified portfolio of investments. Financial advisors, such intermediaries may or may not offer a financial product, but advises investors to help them achieve their financial objectives. Okay? They can tell you where to put your money. These financial advisors usually undergo sales training, and of course they continuously watch and study the market to see which companies would provide the best returns. Credit union, a type of bank but works to serve its members and not the public. Okay, specific group of people. They may or may not operate for profit purposes, normally just for the benefit of the members. Financial intermediaries, pension funds, insurance companies, investment banks, and more. Okay. As for the functions of financial intermediaries, following. Biggest function is to convert savings into investments. For the commercial banks, provide storage facilities for cash and other liquid assets like precious metals. Giving short and long-term loans is a primary function of the financial intermediaries. These intermediaries accept deposits from the entities with surplus cash and then loan them to entities in need of funds. Okay, essentially that's the best explanation for or best description for intermediaries. They give the loan at interest, part of which is given to the depositors, while the balance is retained as their profits. Another major function of these intermediaries is to assist clients to grow their money via investment. Intermediaries like mutual funds and investment banks use their experience to offer investment products to help their clients maximize returns and reduce risk. Okay. Advantages. They help in lowering the risk of an individual with surplus cash by spreading the risk via lending to several people. Or imagine if, a person with excess cash, they just decide by themselves what to do with the money. They could lend it to a friend or a family member, someone they are acquainted with. But there's a lot of risk, right? Because if they give their money to just one person, there's a possibility that they could lose the money if the other person is unable to handle it properly, use it properly. And so if they channel it through the bank, then the bank would at least, do checks, do reviews of whether this person would have the capability to return the borrowed funds, right? Also, they thoroughly screen the borrower, thus lowering the default risk. Next, they help in saving time and cost. Since these intermediaries deal with a large number of customers, they enjoy economies of scale. They have, a well-known process. They have checks, and they have experienced personnel who would do those things for them. Since they offer a large number of services, it helps customize services for their client. For instance, banks can cast the loans for small and long-term borrowers as per their specific needs. Similarly, insurance companies customize plans for all age groups. Okay. Let's say for the banks, if they have a long-term relationship already with a particular depositor and this depositor has a lot of money with them, they can offer loans, or just if they've seen that this person has the ability to borrow money and to eventually, then they would offer them loan services or loan products, and then sometimes to entice them to borrow the money, they would offer lower interest rates compared to the market. They're allowed to do that. They just can't go over the interest rate prevailing in the market, but they could lower it actually, right? They accumulate and process information, thus lowering the problem of asymmetric information. They have a database, and then they consolidate the information and they base their decisions. They analyze the information that would help them in improving their process and would help them in making better decisions. Okay. Continuing on, let us consider a simple example that will help us understand these advantages better. Suppose you need some loan, but you don't know who has enough money to give you. Okay, so to remove that inconvenience, you can just go directly to the bank or financial intermediary. Okay, you contact a middleman who in turn is in contact with those with surplus money, right? Potential issue with intermediaries. It is not possible that a financial intermediary may spread risk. They may channel depositors' funds to schemes that earn them more profits, or due to poor management, they may invest money in schemes which may not be so attractive now. Although, currently, the people have learned, they're experts, probably have enough experience to know how to discern or how to choose which investments would be best. Okay, except for instances like the pandemic, which no one probably expected, right? Such issues with intermediaries, however, are avoidable. Moreover, after the 2008 crisis, financial intermediaries are facing increased regulations to ensure they don't overreach their limits. Right? In conclusion, it is clear that financial intermediaries play a very important role in economic development of the country. Very true. They play even bigger role in the developing countries, including helping the government eliminate poverty and implement other social programs. Normally, businesses, they could get some of their funds from the financial intermediaries, and they need those funds to again operate, to expand, and then that in turn would help employment levels. More people would have jobs, and that could contribute in trying to eliminate poverty. And then, of course, we know that big companies, they have corporate social responsibility. They do provide social programs, right? That could also help the community. However, given the complexity of the financial system and the importance of intermediaries in affecting the lives of the public, they are heavily regulated. Several past financial crises, like the subprime crisis, have shown that loose or uneven regulation could put the economy at risk. Okay, facts. Frequently asked questions. What are the roles of financial intermediaries? Again, mobilize savings into investments for storage facilities such as lacquer for cash and precious metals, safety deposits. Provide funds on the basis of short-term or long-term needs. Normally, if the borrower is an individual, it's going to be short-term, as against borrowed against salaries or future earnings. And then you have long-term needs normally for businesses. They could choose whether short-term or long-term, but normally long-term, right? Assist investors to grow their money by investing and maximizing their returns. Provide interest on investment made. How does intermediaries help individuals? Lowering their risk, saves time and cost, customize services for clients, and then accumulates and process information. Does performing transactions with the help of intermediaries involves risk? No, financial intermediaries help in lowering the risk by spreading it. They have very diversified activities. Everything is almost diversified in relation to financial intermediaries. The functioning of intermediaries is strictly regulated, and hence transacting with the help of financial intermediaries is secured. Okay. When it comes to their customers, very diversified. They could receive funds from any type of person, right? And then when it comes to the investments that they do, it's also diversified into short-term and long-term investments across many companies and across different industries. Okay. And then when it comes to their borrowers, they have also, short-term borrowings, long-term borrowings, and then also spread across multiple industries or different types of borrowers. Okay. So that's it for this one. Again, continuation of the discussion on financial intermediaries. Thank you and bye.